45 years, zero name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
Alrighty. So tonight, first and foremost, thank you guys for taking time out of your day or your night. If you're driving home from work or getting ready to put the kids to bed or making food or whatever you're doing, appreciate you tuning in and listening to us talk about the Austin market. Really, the opportunity there right now through the correction that we're seeing. That's not necessarily a big, scary, immediate, rapid drop. That's a gradual slowdown. That's a return to sustainable prices, regular prices, and that creates an opportunity. A little bit about me briefly. My name is Gavin Cooper. As you can see, I'm a licensed realtor here in the state of Texas. I'm also a graduate from UTSA with a real estate and finance development degree. I've assisted clients both here in Texas and out of state, primarily in Kentucky, with single family and multifamily transactions. And I'm currently at a little bit over 15, itching on 16 million in sales volume. And then, okay, yeah, real quick, briefly, a little bit on Marshall Reddick, and apart from that, what makes a good market. So I guess Marshall Reddick, first and foremost, is a real estate brokerage. Help primary homeowners sell their homes, help primary buyers buy homes. We help investors break into new markets, maybe 1031 out of assets. But really, that's, I guess, like 10% of the battle. Really, 90%, the heavy lifting is done on the back half, operating the property. So believe it or not, we're also property managers. We're in 5 states right now, a little over 3,000 properties across those 5 states, with really a bulk being here in Texas, kind of central Texas and the surrounding areas. We do everything. So full service property management, that's everything from coordinating the rent ready phase and making sure vendors are out there and completing work. That's listing the property, running the leasing process, screening tenants, collecting rent, dealing with day-to-day maintenance orders or requests, day-to-day phone calls from tenants. Like I said, it's completely a full scope, full service that we provide. Apart from that, we try to, or I guess pride ourselves on really being a one-stop shop. So we do private money lending, and that's, I guess, geared towards obviously borrowers, and then the investment fund, which is geared towards, you guessed it, investors. So quickly, a little bit on the private money side, that I guess really pertains to, let's say you're a seasoned investor and you have like 10 properties. You're not necessarily going to qualify for a conventional loan anymore. So you'd go through a private money lender, or maybe you do fix and flips and you see a super sweet deal and you want to close on it, and you need to do it tomorrow or within 5 to 10 days. You would go through a private money lender. Good luck doing that through a conventional lender. And then I guess to kind of facilitate that, we have an investment fund. So we work with accredited investors who allocate capital. We take that capital, invest into mortgages, collect an interest rate, and then pay back out to our investors at about a 2.25 to about 8.5 annual yield. So like I said, fully a one-stop shop. That's what we pride ourselves on being. And then a little bit briefly on what makes a good market. Why are we in the markets that we're in? Like I said, we're in 5 states at the moment. First and foremost, the job market. Is there a lack of employers? Is there a lack of employees following the employers? Probably a no-go, a market that we're going to want to stay from. Whereas, if we're seeing employers go in droves, employees follow them, that means we have tenants who can pay rent. That's a good thing. That's one piece of the puzzle. Second, we're looking at vacancy. Some markets are more geared towards homeowners, whereas others are geared towards renters. So you're going to kind of want to find that happy medium, maybe even teetered towards or weighted towards being a little bit more heavy on the renter side. Economic diversity is also a big factor. You don't want to necessarily pigeonhole yourself into one industry. I take a Detroit and the automotive industry, for example. What happens if it fails? What happens if it pulls out? Now you're kind of stuck. You're stuck holding. Maybe you have to sell, you're stuck waiting, whatever it is, it's probably not a good situation. So you want some diversity there, whether it's tech and medical or military, automotive industry, industrial, manufacturing. You want options, so all of your eggs aren't into one basket. Housing affordability is also a pretty essential factor. I guess for this, we could compare a pretty easy one to like an Orange County, California, to like an Austin or San Antonio, Texas, where in those Texas markets, you can get into a single family home, couple thousand square feet, ready to move in ready for, $300,000 plus or minus, whereas that'd be totally far-fetched, at least something, a couple thousand square feet, plug and play in a county or in Orange County in a market like that. We're also looking for a market that's landlord friendly. So again, we can compare a California to a Texas. Texas, the laws, the regulations are geared towards landlords, investors, property owners, property managers. This makes our life, your life as an investor, a lot easier. Everything from mundane tasks like collecting security deposits at the end of like a tenant renewal, or maybe even bumping rent during a renewal. The eviction process is a lot easier, a lot quicker here in Texas, or rather landlord-friendly states. So like I said, it makes operating an asset a lot easier. And as I mentioned earlier, that's really the bulk of the work. 10%, what am I buying? Does it pencil out? 90% is operating it. Apart from that, the two last things that we're kind of looking for is strong education and reliable property management. Strong education in the sense that we have good public schools, and with those good public schools comes good universities, comes educated white collar jobs, good paying jobs, and for you, great tenants with money to pay rent. Apart from that, you're also looking for reliable property management. So this is kind of like how you want economic diversity. You don't want one option. What happens if the relationship sours? What happens if they decide they don't want to manage anymore, or in that market? Again, you're now kind of stuck managing it by yourself. You're stuck kind of in a frenzy trying to hire someone. You want options. So those are kind of, I guess, like the 7 pillars that we would go through in terms of what makes a good market. Here are the states that we're in. I guess from left to right, Newport is actually like our headquarters, where we're based out of, office in LA. Come down to Texas, you of course have all the big cities, your Dallas, your Austin, your Houston, New Braunfels, and San Antonio, kind of right on top of each other, but 2 separate offices. We have an office out in Florida, and then 2 in Tennessee, but that Clarksville office is like super close to the border. So we also manage in Kentucky as well. These are the fine individuals who make the show go around here. That's everyone from maintenance managers, property managers, tenant coordinators, agents, the whole shebang. They're all here. And then this is Leroy. Leroy is an experienced sales agent, top sales agent here at Marshall Reddick. So with that said, I will give it to Leroy and let him fill you guys in on his background.
For sure. Thank you, Gavin. Thank you for letting them know a little bit about Marshall Reddick. A little bit about me. My name is Leroy Ramirez. I'm a licensed real estate agent here in San Antonio, Texas, and a lifelong Texas resident. I've been here all my life. I've seen the growth and been part of the growth the last 10 to 15 years. It's been amazing. Before Marshall Reddick, I call it the 3 W's. I worked for Wachovia, World Savings, Wells Fargo as a loan processor and as an underwriter. I then worked at new construction started off as a sales representative, moved up to management. I was doing management for about 2 years. Managed a community on the far west side of San Antonio, and then one on the south side of San Antonio. So the builders I work for, probably builders that you probably invested in already. So Lennar, Starlight, and Century Communities. I then decided to go on my own. I got my real estate license, and I found a home here at Marshall Reddick, and I love it because it truly is a one-stop shop. Everything is under one umbrella. I own a primary home in San Antonio. I'm happily married. I have 3 boys. It's a joke. I have two dogs that are boys as well. So my wife is the only queen of the household. So there's a lot of testosterone. So feel bad for her sometimes. Other than that, in the last 12 months, I've done about 50 transactions and counting. Besides, real estate, besides work, I don't really do much. If I'm not at work, I'm at home watching a movie, spending time with my kids, or I'm serving, volunteering at the church. I do like to flip homes. I don't recommend that right now so much, but that's pretty much me. I just kind of like to spend time at home with the family when I'm not assisting clients here at Marshall Reddick.
Sweet. Thank you, Leroy.
Yeah, no worries. So we are going to talk about, Austin, Texas, right? So why Austin, Texas? So Austin, Texas is ranked the #1 best performing city in the United States. It's #1 in a 5-year job and wage growth. #4 among large cities for high-tech diversification, and #8 in 5-year high-tech GDP growth. Between the years of 2017 and 2022, the wages have increased dramatically. They've gone up 73.1% in the Austin metro area. And if you go to niche.com, it's going to be an A grade for public schools, family living, nightlife, and diversity. There's just so much things to do in Austin. Super cool. There's a saying, keep Austin weird. And it's pretty, if you haven't been there, I recommend go checking it out. It's a fun place to be. Top of that, if you love music, the music scene in Austin is second to none. It's earned the nicknames live music capital of the world. There's a big event called ACL, Austin City Limits, where the city just shuts down. Everybody just is usually going and enjoying the music. It's really cool. And like I said, I like to go. I don't live too far from there, so me and my family like to go enjoy that as well. But it's a really unique city. And like I said, I recommend you visiting if you have not already.
So we got a couple of different questions for you guys tonight that Leroy and I were just kind of wanting to talk through. I'll read them out for you guys. Leroy, why is now a rare window to buy in Austin, and what's changed since the market peak? And I quickly, before you comment on that, I know for me, I just quickly would like to mention that I think it's a rare window. I saw in 2021, appreciation hit 30%. And since then, since 2022, 2023, 2024, we're seeing a decline. So yeah, it's presenting a pretty low barrier to entry. We're seeing a lack of bidding wars, which was really driving up price. Sometimes people were honestly just buying for the sake of buying because of hype. There was a lot of frost, so that's kind of dissipated. And then just the amount of inventory that we had start or stop or freeze during COVID, a lot of that's getting delivered, primarily in 2024 and beyond. So again, that's really pushing rates down and putting some people in, builders specifically, in some kind of tough spots. But Leroy, I don't know if you wanted to put your thoughts on that.
No, definitely. So it's like, what's changed since the market peak? So right now it's going through a market correction. So you're going to hear me repeat this throughout this presentation, but a correction is not a crash. It's leveling off. It's leveling the playing field. So right now it's a rare window of opportunity because the buyers have the upper hand now, as opposed to in 2022, mid 2022, when we were going through bidding wars and fighting for inventory, and just builders were just taking advantage at that point. Now the tables have turned. The buyers have the upper hand. There's sitting inventory that we can take advantage of. There's no more of that bidding war, so you're not overpaying 20, 30, 40, 50,000 at times just to get into Austin, and the terms are a lot better. So it's definitely changed since the peak. Another thing I want to touch on is the interest rate. So right now, interest rates are what they're calling high, right? But I feel, again, I'm not a loan officer or anything like that, but if by doing my research, I feel that's going to stabilize or maybe fall or drop a little bit. So that offers potential for refinancing. But if we're getting homes and getting these great deals at under the appraised value, you can refinance that the price. So you're getting at a lower price, and hopefully when it drops, then we refinance at that point. But if we look at things in a whole in Austin, the fundamentals have not changed. Austin still remains a tech and job hub. It also has continuing population inflow in Austin. So that's really what I've seen that's changed recently with between now and the peak.
Thank you, Leroy. So I know what this means for me, but I guess really, what does a market correction really mean, for buyers and investors in 2025? And I think we could probably sum it up as just, opportunity. It's a head start on appreciation. Like Leroy was saying, we're in a correction. It's not this downfall. It's not this pit. It's not a crash, and we're also not in the peak. We're returning to normal, and that's creating a great opportunity. I don't know your thoughts on that, Leroy.
I think you hit the nail on the head. It's opportunity. What does a market correction really mean? Again, it's a correction. It's not a crash. It's the market leveling out after a period of unsustainable growth. Austin's home prices exploded during the pandemic. It went upwards of 45% in those 2 years. So by mid 2022 or so, we saw the median income in median home prices north of like 540, 550 in Austin. If you fast forward that to today in 2025, prices have corrected itself, started to level off. So now we saw a drop between 18 to 25%, bringing it closer to the 2021 level. So today we're looking at median home prices of about 440, 450, so in the mid 400s. So that's a significant adjustment. What that means is for a lot of investors is Austin is back on the menu. For a while, it was off the menu. So now it's back on the menu. The dynamic has shifted. Like I said earlier, we're not fighting through those bidding wars. We're not overpaying, offering 50K over asking price. You have more inventory to choose from. Inventory is up 15% year by year. And one thing I do want to mention is builders. Coming from a builder background, builders right now, they're going to start going into what we call the slower times, the fourth quarter, September through December. So September through December are historically a little bit slower. Why? Because right now, August, school starts back up. I myself have my getting ready for my son to go back to school. I'm not thinking about anything else but make sure his shots records are good. He has clothes, the shoes, meeting the teacher, all these things. And then we start heading into October, November, December, where we're talking about Halloween, Christmas, Thanksgiving, New Year's, all that. So it's a little bit slower. So what that means, we can take advantage of the time. So right now, builders are competing for your business. And what they do is they offer rate buy downs. They are covering closing costs or assisting with closing costs. They're diving deep in the pockets just to make deals happen. We're even getting some items like fridge, washer, dryer, blinds, small items like that we normally wouldn't get. But like I said, now that it's flipped, we have it's on the buyer. We have the power now. So let's be real. So if you missed the boat in 2020, this may be your last before boom moment in Austin. The correction definitely brought prices back down. It softened the competition, opened the door to come back and invest in Austin. So whether you're a first-time investor looking for a single-family home, a seasoned investor looking for a multi-family, I just want to tell you, Austin is definitely not cooling off at all whatsoever. It's just resetting, restabilizing itself, and I love it. I think we have to take advantage of that. So as we know, this is a great time to invest when we have the fourth going into the fourth quarter, taking advantage of all these things that we have. It's just a great time to put Austin back on the menu.
Thank you, Leroy. Actually, we got a question from the chat. They were wondering, and guys, if you have questions, feel free to throw them in there. They were wondering right now what would be, I guess, kind of like an ideal amount for a down payment. Probably about 20, 30. I don't know your thoughts on that, Leroy.
No, yeah, same. So we recommend 20 to 30% right now. 30% seems to be what's making the cash flow a little bit better. It just depends on what's important. Are we looking for, is cash flow important to you? If not, then it's it just depends on that particular investment or investor, but I would recommend 20 to 30% at the highest.
Okay, thank you. And then here's another question for you. How do we separate hype from opportunity? Quickly, I guess commenting on that. Hype I kind of see as like emotional, like, oh my God, everyone's buying. I'm reading all these news articles and like I have to get it now. Versus opportunity is a little more logical. You're thinking it through, you're looking at the numbers. So I think really in the simplest form, the easiest way to separate it is you have to do your underwriting. Get your pro forma ready. Does it pencil out? If it pencils out, good, it makes sense. If it doesn't, move on, you're on to the next one. It's kind of my take on that, Leroy.
Yeah, no, I think you're right. You said hype is more emotional. And then, opportunity to me is more strategic, the facts, the numbers, right? The numbers and the facts are going to tell it all. They're going to tell the story. So I live, like I said, in San Antonio. It's not considered, as the nightlife and have all these cool things like Austin does. Austin gets a lot of attention from tech giants, influencers, real estate gurus, TikTok trends. I mean, it's really easy to get swept up in that hype. But smart investors know we don't follow the noise, we follow the numbers. So again, going back to the fundamentals. So you really have to think about Austin and ask, are jobs, really growing? And that's a yes. Is population still rising? Yes. And then also just kind of look at what the absorption rate, trend rates. When you look at Austin's job market, it's still expanding. Major employers like Apple, Oracle, Samsung, they're still investing heavily in those regions. So that means population growth is still trending up. So yeah, I mean, and then also you got to think about the builders. Going back to the builders, new construction, they're not overbuilding it like they were back in those 2008 days. So I think short answer, how do you separate the hype? Just not buying emotion, but look at the numbers.
And new construction really has started to slow down. That like huge influx of inventory is starting to calm down, which is really helping. Here's a property pick. Leroy, I'll let you run through the numbers here and fill us in a little bit on the property if you could give us a skinny.
Yeah, for sure. So I wanted to give an example. So we have two examples that I want to show you. This one here is going to be a fourplex. This is a little bit older property, built in 1982, listed at $675. I put 30% down. It's $1,500 per unit. So right now the gross rent is $6,000. When we added taxes, insurance, management fee, we're looking at a fixed monthly expense of $45.56. So it's generating right now an income of cash flow of $14.43 a month. I really like this property, not just because of the cash flow, but because of the location. So it's in the southern South Menchaca area of Austin. So it's in a good area where there's a lot of opportunity for growth, and still close enough to drive to Tesla, Oracle, about 20 to 30 minute drive to work. So the good thing about this is, it's in those areas in the southern part of Austin. It'll be a little bit more affordable than it is more going towards like North Austin. So this was a good example that I sent out to one of my investors that we're looking at it right now. But I thought it was a good time to kind of show this, to give two examples of one of a pre-owned, what we look for on deals, and then what of a new construction. But again, you want to take a look at that price, $675. What I would do again, I know that it's a buyer's market. So just because the price is $675 doesn't mean that's the offer we're going to put in. So right now is the time to be aggressive. I would be strategic with it. Maybe ask a little bit off the price and get some incentives. But I just want to kind of give worst case scenario numbers. This is what it was looking like, and it's still panning out. So this is a really nice property pick that I wanted to show.
Thank you, sir. So obviously there's a variety. We have single family homes, new construction. We have single family homes that need a bunch of value add. We have duplexes, quads. is there any, I guess, property in particular right now that you're thinking outweighs or makes more sense? I guess what's your take on this?
I mean, it really just it depends on case by case base. Do you want a pre-owned home that you're willing to dish out a little bit money to get it to spend a little money on, or you want to go with new construction, single family or multi-family route to where you're a seasoned investor, maybe you want to get want to diversify your portfolio. So I think it really varies case by case, depending on what their investment goals are.
Yeah, this is 100% looking inward. What's my risk? What's my skill set as a real estate investor? Should I really be taking on something that needs $120,000 of renovation, or would it maybe make more sense just to buy a new construction build that I can hit the market on as soon as I close? So I completely agree with Leroy here. This is 100% case by case. This is looking inward. What's my risk? Where am I at? What's my goals in the next 5 to 10 years from now? Am I looking for cash flow? Am I really just focused on appreciation? It's a long term.
But yeah, I mean, but we try to look for, again, so what properties make the most sense is case by case, but we still look for the same, the game doesn't really change. We always kind of look for growth. Does the neighborhood have infrastructure coming? What the rental rates look like, what it's going to look like in the future, and then am I buying below the appraised value? So we kind of try to stick to the same, meat and potatoes, but I guess, we try to cater to just depending on what's important to you.
Here is a pretty interesting graph. Down here on the right is the numbers I was referencing earlier. You can see in 2021, look at that jump from 2019 to 2021. That is absolutely nuts. And obviously, if you keep looking, 2022, 2023, 2024, you see that correction happening. You see the slowdown from 21 to 22. You see a bigger slowdown from 22 to 23, and now we're really in the thick of it, at almost that point, almost at 40% down from where we were a few years ago. Over here, this kind of, I guess, illustrates the dip. You can see it's really, really like rocketed from this 2019 time, and then just all of a sudden we're down. So we're down, but we're still above. We're still above the last 20 years or so. So it's obviously still a market that it's still a strong market. I don't know if you have anything to add to this one, otherwise we can.
No, for sure. So I don't know if we have anybody out there that invests in crypto, but there's a saying, buy on the dip, right? So that means buy it when it's low. So right now, if you look at the chart from 2000 all the way to 2024, we're in the dip, the red area. So what happens after the dip? It eventually goes back up. So I say, I call the red the negative. I call that the rainy days, and then the green, the positive, I call that the sunny days. So we all know after the rain, after the storm, there's always comes the sun. So 2023, 2024, 2025 will probably still be in the red a little bit, but 2026 into 2027, we all know the sun's going to come back out. So right now, like I said, it's a rare opportunity where it's stabilizing, where you can get, a property at a good price and, buy on the dip.
Yeah, it's cyclical. It's bound to bounce back up. Just kind of in a way timing that. Right now we're there. The answer to this is yes. Are builders or sellers offering concessions? Yes, we're seeing, like Leroy said, and I'm sure out to it, rate buy downs, purchase prices are being knocked down, 75, 80 grand. Sellers are coming to the table with incentives. Just across the board, we're seeing a bunch of different incentives, really whatever it takes to get a deal to pencil out right now, or rather for a seller to sell their home, or a builder to sell their property.
Yeah, I think, our builders offering concession, yes. Our sellers offering concession, yes. Yes. So this gets me excited because this is the time to negotiate. This is the time to put in offers. It's really flipped Like I said, back in mid 2022, it was like, do you want it or not? Because I have someone else that's going to buy it. That was the mentality of the builders. That was the mentality of the sellers. Well, now it's changed. Now it's a time where we can get aggressive, ask for some incentives, ask for those incentives to make the deal a little sweeter. So short answer, yes, yes, yes.
Perfect. Our company's still relocating, expanding to Austin. Yes, Austin, or excuse me, Apple is, expanding their pre-existing campus. Billion to One, who does like biotech and diagnostics, they're 1.5 million square foot industrial building that they're building out there. So we're still seeing employers flock here in droves, expand onto pre-existing properties. All of the above. Leroy?
No, definitely. So, I have a printout here that I want to read to you. So, Realtor.com relocated from California to Austin as its official headquarters. They plan to hire 200 employees. X Corp, which is formerly Twitter, so X, moved its headquarters from San Francisco to Bastrop, Austin area in September 2024, adding 2,800 employees locally. AppSignal, Peak Six, an additional 1,500 employees joining the local workforce. So that's what's going on right now as far as expansion. So NXP Semiconductors is expanding. SpaceX is in Bastrop. It's expanding, adding an additional 400 jobs. Ninja One grew its IT software operations, adding an additional 300 rows. I mean, the list goes on. Apptronic, Firefly Aerospace, Silicon Labs, Tokyo Electron. They're adding, each of these companies are adding 30 to 1,800 jobs across the Austin and surrounding areas like Bastrop, Cedar Park, Manor. And we all know that jobs create population growth. Population growth goes towards equals more housing demand. So our company's still relocating. Yes, they're still investing in Austin. And again, with that, it just causes more housing demand.
What are the risks right now, if any, investing in Austin or during a correction? And I guess, how could we mitigate them? I guess the biggest thing that comes to me, or I'm sure as investors for you guys too, there's always that concern of, did I buy too high? Should I have waited a little bit longer? That timing, that market concern. So that, I guess, is the potential for risk here. Maybe it's not timed as best as it could, but that said, and looking at the data in the graph a few slides ago, now is the time. I mean, it's down, like it said, almost inching on 40%. Now is the time. So I wouldn't necessarily associate that with the risk. But Leroy, I don't know if what you would like to add to that in terms of any risks that you see, how you would deal with that.
No, definitely. So let's be real, right? So there's always risks with investing, whether it be in stocks or your 401k, or anybody that invests in crypto. We all know that's high risk. Real estate is probably the safest risk out there. But there's still risk involved, right? So for us during this correction, it's really important that we take advantage of the market. If we were looking for a pre-owned multifamily or single family, I look at how many days on market they've been sitting. So if they've been over, let's say 90 days, I know that they're hurting. So I know that I'm able to put in an offer under the appraised value. I know that I'm able to negotiate some incentives as well. So I try to mitigate the risk by, trying to make a deal happen, buying under the appraised value. Also looking for those neighborhoods that have a lot of growth. So what infrastructure projects are being planned today and in the future? What are the rents historically looking like pre-COVID, right now, and what do they look like in the future? So that's a good way, kind of rule of thumb of how to mitigate the risk. Again, I don't have a crystal ball. Can't tell the future, but if we kind of stick to the same game plan, that's a great way to minimize those risks.
I'd say when you guys are going to purchase something, don't overextend yourselves. Don't over leverage. Too much debt to value. Make sure you keep it within the lines. And also, you might see in some submarkets maybe oversaturation of renters, which could maybe drive prices down if we're having to be more competitive. Maybe properties are sitting on market for a little bit longer, and that's obviously to its specific submarket. But that's also something that you want to look out for. Here is another property pick for you guys. Newer build, 2024. I'll let Leroy fill you guys in on the pro forma here.
Yeah, so I wanted to give you two options. One of them was going to be a pre-owned fourplex, just to kind of give an example, a little bit smaller, may need some work in it, but then I wanted to show you a new construction. So I'm a raving fan of this builder. They have a really nice product. This one is located just on the outskirts of Austin in Buda, Texas. So there is just a lot of growth happening in that southern region part. The beautiful thing about Buda, Texas is that you can live there and rent a little bit lower. I would say maybe about save $800 to $1,000 a month, but still drive to Austin for work. So that's what we're getting here in this community. We're getting a lot of young tech professionals that are looking to save a few bucks. So they're living in Buda and working in Austin. So that's why I particularly love this location. About the builder though, so this builder, man, they just have a really, really nice product. You're going to find granite countertops, high ceilings throughout the duplexes. When I show these duplexes, it really feels like they're living in a single family home. It doesn't feel like a duplex. So that's why this builder has been able to, we've been kind of selling a good amount of these because just the feel, the finish, it's a really, really nice build. This example here, it's priced at, this is a 4-bedroom, 3-bath each side, and you're looking at a list price of $651,500. Again, using our 30% down example, we're looking at a monthly, a cash flow is $628 a month. We're looking at gross rent $4,250, and then a fixed monthly expense of $3,600. So we're cash flowing here, a little bit over $600. But what I really want you to focus on is where it says right under gross rent, it says mortgage payment, and then it says 3.75 interest rate right there. That's why this is making sense. So what the builder is doing is they're doing a 10-6 ARM. When you do 30% down, they're offering a 3.75 interest rate. That is amazing. I'm not even getting that with single family homes, right, Gavin? I mean, that's an amazing interest rate, 3.75. So they are doing that with 5% down. They're doing a 4.25. So the numbers still make sense. So not only this builder is, do I like the finishes? The location is good, but now when they're adding that like a cherry on top of the 3.75 interest rate, that's why this product is moving. So I really, really, really like this builder, and it's new construction. So new construction usually comes under warranty. That means you're not going to have to really put much, anything up front. It's going to be 1 to 10, so 1 year from doorknob to doorknob, 2-year electrical behind the walls, and then the 10-year foundation. So that's just another cherry on top of this. I don't know if you want to add anything to it from Gavin.
I'm just look at that return after 15 years, 25%. It's just absolutely killer. And I agree. Like Buda is such a sweet spot in terms of location. You're not in the hustle and bustle, I guess, of Austin. You're not dealing with. I mean, look at that tax, 941. You're not dealing with the same tax rate as there is in Austin. But it's still close enough to Austin that people want to live there. You don't feel like you're in the middle of nowhere, or maybe you do. There's a lot of farmland and stuff, but you're not. You're still a couple minutes away from the highway. 20 minutes from proper Austin. And an absolutely wonderful location. And I think new construction is like unbeatable right now. I mean, like you said, 3.75, like that's something that you're not seeing right now, unless it's a, an interest rate buy down.
Yeah, it's tough to get 3.75 from a a pre-owned buyer to because that's a lot of money that the builder's doing up front. So it's very tough for someone to put up that type of money to buy down the interest rate. So that's what's unique about new construction right now, is that they're really getting creative because they don't want to sit on their product. The longer it sits, the more money they're losing. So they're being really aggressive now. Like I said, the tables have turned. It's a buyer's market right now, and I mean, you can just see it here with the rate buy down at 3.75. That's just amazing.
This is kind of, I guess, what I was referencing earlier. I don't know if no, I can't. Sorry, guys. Oh, my apologies. All over the place now. Okay, yeah. So like I was saying earlier, I manage over 3,000 properties across 5 states, a bulk of which is here in Texas, San Antonio, and the surrounding areas. Austin is all these yellow pins right there. So as you can see, pretty vast. About a little over 2,200 properties right now in the Texas market that we manage. And then this is just briefly, I want to comment. Our website's an awesome resource for new investors, for savvy investors. There's content on there for everyone, related to property management, related to making a smart purchase. There's data packets on like Dallas or Houston if you want info on markets. You can use our calculator and kind of run a little pro forma. It's all there. And then this briefly is also a snippet from our website. This comments on our property management fees. Only have 3 fees: 50% lease renewal fee, 50% leasing fee, and then our property management fee, which can vary obviously depending on single family home, 2 to 4. And then quickly, I guess I would like to just comment on some good stuff for you guys. Whenever you are calling around and doing your diligence with property management, I would ask if they profit. Are there markup from profit from maintenance? Are there markups on repairs? Are there coordination fees, admin fees, little, like I call them kind of junk fees like that? Or is it a proper property management company with making their money off of managing a property, off of leasing a property, doing renewals?
I'd like to add a little bit of before we go on.
Yes.
So I do want to brag a little bit about our property management. So before here, like I said, I didn't start my career at Marshall Reddick. I'm glad I found, a place I can call home now. But before Marshall Reddick, when I was helping investors, I would have to outsource to a property management company to get the home lease. Well, when you don't work for the property management company, it's very tough to get a hold of somebody. Well, here I'm an agent. Gavin's an agent. We will not only help you purchase your home, but we know that the property management, whoever that leasing agent is within our company. So if you can get a hold of them, you can get a hold of us. If you can get a hold of us, you can get a hold of them. So it's really, truly a one-stop shop under one umbrella, and it makes communication so much smoother. And having the process and the people in place just makes things a lot smoother all around.
Yeah, like you were saying, it's not just a one-man show. You don't have one person who's doing the leasing and doing the maintenance and dealing with tenant day-to-day complaints. It's split up. You'd have a 5-man team. So like Leroy was saying, if the property manager is unavailable, you have a tenant coordinator, you have the sales agent who sold you the property, or the leasing agent who's leasing the property. There's always someone available to help you. So I agree. It's really an unbeatable service. There's a question. What kind of properties are you seeing move the fastest right now? Single family homes, multifamily. Are you seeing a discrepancy there in the two, Leroy?
No, I mean, to me, single family and multifamily is moving. I guess I see more the new construction moving a little bit quicker. And again, that's only because of the incentives that they're offering, the warranties that come with the home, and then also there's a lot less upfront costs associated. So when you purchase a pre-owned home, we may have to spend a little money to get it look decent to where it's ready for rent, as opposed to a new construction. We know it's new, and a lot of times they're already coming with like a fridge, blinds, garage door opener, small things like that add up front. So I would say single family, multifamily, they're both moving at a great rate, but I would lean more towards new construction versus pre-owned. I don't know if you agree with that, Gavin.
Yeah, I'd 100% agree with that. Unless you're really into the fix and flips, or maybe you're super savvy, or like doing DIYs, I'd probably stick to the new construction. It's what's appreciating the best. It's what we're seeing the best opportunities on right now. It's construction that you're not going to have 10 years worth of deferred maintenance on, that you're not having to spend 40, 50 grand sorting out. It's a cleaner, easier option for many. Someone else was curious, is there a sub-market or specific area of Austin or the surrounding that you like, or you think are better than others, or you're focusing on?
Yeah, so I personally like to look at certain zip codes in the southern part of Austin. The reason for that is because I feel like those zip codes, they still have some affordability, but they still have a lot of growth happening. So there's still a lot of potential happening in those areas. So a lot of infrastructure projects that I was looking for. The rents are also pretty decent, with the potential of them going up as well in the future. So I like that southern part of Austin, if we're talking about Austin. And then below Austin, we have the example that I just showed you in Buda. That's a really nice option. Buda, Kyle, San Marcos, all that little area is growing tremendously. So I like that southern Austin and below. It reminds me of San Antonio. It's downtown, and that's where the city's at. But as it grew, all the outskirts grew, right? Castroville right now is growing in San Antonio. We have New Braunfels. We saw the boom in New Braunfels, Schertz, Seguin. So we see all the outskirts of San Antonio just growing. So if you think about it, it's kind of like a hamburger, right? One of the buns is San Antonio, one of the buns is Austin, and in between is like the meat and the lettuce and all that stuff. So all those states, or all those cities in the middle, that's where the growth is happening, all around Austin, the surround, like southern Austin, and between Kyle, Buda. So I like that area. I like to where they can live in, like, say, Buda, but still close enough to drive to work in Austin if they have a tech job. So that's what I kind of like.
Perfect. Well, that is it for the questions. Here's my email. Here's my phone number. If you guys have any other questions, feel free to shoot us a reply, and Leroy and I would be happy to hop on the phone with you guys, or hop on a quick video chat and talk through anything. That's it for me, though. Leroy, I don't know if you have any parting comments before we wrap it up.
No, just thank you for your time. Like I said, here at Marshall Reddick, we don't just service San Antonio or Austin, we in between as well. So I know this was just about Austin. We did want to talk about Austin and let everybody know it's back on the menu for a lot of investors. I'm getting a lot of calls right now specifically for Austin. So it's back on the menu. So I think it was important to have the seminar, a webinar, so we can kind of let you know what we're seeing, right? Because we're technically your eyes, your ears, and your boots on the ground. So this is why I feel like I said Austin isn't cooling off. It just had a major reset. It started to balance, and what better time to get in right now than in a buyer's market. So right now we have the upper hand. There's more inventory sitting, no more bidding wars, and that's our job, to negotiate the best price and to get you the best incentives as possible. So yeah, and I appreciate everybody's time.
Well said. Thank you, Leroy, and thank you guys, everyone who's attended tonight. Again, we appreciate your time, and we'll see you guys in the next one. Thank you guys. Have a good night.
Good night.